Welcome back to Investor Katta. Debt market instruments are popular amongst investors because they are considered safer investment option compared to equity market instruments. And why this is generally true? There are certain debt market instruments which are riskier than some equity market instruments. So I think it is very important to understand the risks associated with various debt market instruments for investors to make an informed decision. In this video, we are going to discuss potential risks and expected returns from various bonds options with a particular focus on covered bonds. Before we start though, if you are new to our channel, please consider subscribing to get notified whenever we upload a new investment related video. So let's get started. Usually, higher the risk associated with an investment, higher the potential return. I would categorize debt market instruments into three categories: FDs, bonds, and other debt market instruments such as peer-to-peer lending and invoice discounting. Usually, FDs give lowest returns, bonds give moderate return, and other debt market instruments give moderate to high returns. So, this means FDs are safer than bonds and bonds are safer than other debt market instruments, right? Well, not exactly, because there is one more additional factor that plays a crucial part in this risk versus return dynamics, which is liquidity. Government securities, which is a type of bond, yields higher returns compared to FDs because FDs are more liquid than government securities. Having established that there is always a trade-off between returns and combination of risk and liquidity, let's dig a little deeper to understand various types of bonds. There are several ways to classify bonds and debentures, which we have already discussed on our channel in a detailed video about bonds and debentures. You can get the link to that video right here and also in the description below. In this video, I am going to distinguish between different types of bonds based on the associated risk. In the increasing order of associated risk and expected returns, bonds can be classified as government securities, covered bonds, secured bonds and debentures, and unsecured bonds and debentures. In this video, we are not going to discuss about debt mutual funds as they can invest in one or more types of debt market instruments. Government securities are safer than FDs and yield slightly higher returns than FDs. They are fully secured by sovereign guarantee, that is government guarantee, unlike FDs, which are insured for only up to Rs 5 lakh in case bank goes bankrupt. Now let's talk about secured and unsecured bonds. Obviously, unsecured bonds yield higher return compared to secured bonds. In case of secured bonds, issuer pledges assets against the bonds which can be used to pay the debt in case the issuer defaults the payment. One key aspect about safety of bonds and debentures is credit ratings. These ratings are given based on the credit history of the issuer. Do not invest in bonds and debentures with poor credit ratings, even though they are secured. But didn't I mention earlier that secured bonds have assets pledged against them? Then what is the problem in investing in a poor credit rating bond if they are secured and if they are giving great returns? Well, this is where liquidity comes into picture. When a company files for bankruptcy, its assets are liquidated and the stakeholders are paid their dues. But there is a catch. The priority in which the stakeholders are paid their dues is number 1. Government dues such as income tax, GST, etc. Number 2. Banks or NBFC. Number 3. Secured bondholders. Number 4. Unsecured bondholders. Number 5. Preference shareholders. Number 6. Common shareholders. The bankruptcy processing can take years, and it is possible that at the end of the process, you might not be able to get your money back in case the debt owed by the stakeholders above you is too high. I am sure you all know the case of DHFL and ILNFS. Both companies failed to pay their bondholders, and even though those bonds were secured, bondholders are still waiting to get their money back. Covered bonds are safer than secured bonds. The major difference between covered bonds and secured bonds is that the assets pledged against the covered bonds are transferred to the books of a third party called trustee. Consider an example. Company A, which deals in gold, vehicle, or housing finance, wants to raise some capital through covered bonds. They will go to a company B, which is a trustee, and transfer some assets such as gold loans, vehicle loans, or home loans worth more than the amount they want to raise to their books. Investors then pay the amount to company A. If some of the assets become NPA, usually company B will ask company A to replace those with new assets. This ensures that company B always have assets worth more than the issued debt on their books. In case of an unfortunate scenario that company A goes bankrupt, company B can simply liquidate the asset and pay out the bondholders without worrying about bankruptcy processing. The reason covered bonds aren't commonly discussed as an investment option is because till last year they were restricted only for NBFCs and high net worth individuals. But recently, a platform named Wint Wealth has made covered bonds accessible to retail investors. For this, you need to create an account with Wint Wealth on their website. I have given a link in the description below. The minimum investment amount starts from Rs 10,000. Now once you have created an account, you can explore all the currently available investment options. Click on a particular option to check details. So let's look at an example. This particular bond was issued back in June this year. You can see that asset size, which is the debt amount, is lower than collateral size, which is the asset pledged against the debt. This bond was issued for a period of about 15 months. Now, this particular option is sold out, but you can set up a notification for it if you wish to buy it from someone in future who might sell the bond for some reason before maturity. Now, let's discuss some advantages and limitations of covered bonds. According to Wint Wealth, this chart shows the payoff between risk and return from different investment options. If I want to add government securities to this graph, they will lie somewhere here. It is important to note that liquidity of almost all types of bonds is lower compared to FDs. So, one must consider that in addition to risk before making an investment decision. One major advantage of investing in covered bonds is that the risk is comparatively lower for almost same or sometimes even higher returns compared to secured bonds. Risk is slightly higher than debt mutual fund or FD, but returns are substantially higher as well. Another advantage of covered bonds over other bonds and FDs is taxation. The coupon paid on bonds, which is nothing but interest, and interest paid on FDs are both taxable according to your tax bracket. This is especially important if your current income falls in higher tax bracket. Covered bonds, on the other hand, are market-linked debentures, which means that under normal circumstances, you will pay long-term capital gains tax, which is around 10%, as long as you hold them for 12 months or more. Short-term capital gains tax is around 15%, which is still lower compared to those higher tax brackets. Another advantage of covered bonds is that their credit rating is always higher than the issuer. This is because regardless of the financial health of the company, covered bonds are always issued against higher amount of assets. Let me highlight one key limitation though. Although your principal and interest both are safe, in case of a default event, you might have to wait for a while to get your money back. How long, you may ask? For this, you need to visit Cover Pool tab on Wint Wealth website for the investment you are interested in. For example, in the previous example, we checked on website with expiry date of 9 September 2022. You might have to wait until 11 June 2023 for payout in case of a default event. This is because the underlying asset, also called cover pool, had a maturity date of 11 June 2023. The reason I am highlighting the need to check such minute details is because this period can be as high as 4 to 5 years post maturity of your investment. One good thing about such an event is that you are paid bonus interest as the underlying value of assets is much higher compared to debt. But still, you might lose some value of your investment to inflation as you are not paid any interest for the period between maturity date and full expiry date. I want to clarify that this is not a sponsored video and I am not being paid by any company or platform to promote their product. This video is not for financial advice. The purpose of this video is to share my thoughts about this product with our viewers. If you like this video, don't forget to smash that like button and share the video with your friends and family. Also, feel free to share your feedback in the comment section below. We have a variety of videos on various debt market instruments. I have shared some of them in the description below. So do check them out. Thank you.